Hey there, my investing curious friends. Welcome to Opening Bid. I'm Brian Sozzi, Yahoo Finance's executive editor. Thank you for joining us either on YouTube, Yahoo Finance, or Spotify. Now let's make some money and get a lot smarter. Joining me today is Deutsche Bank Chief U.S. Economist Matthew Luzzetti. Matt, good to see you.
Thanks for having me.
Yeah. We're look, friend of the show. You've always been on Yahoo Finance, but I've never actually asked you to walk me through your day. What is a top economist's day like in an environment where stock markets are volatile, views are changing about the economy? Take me through. All right, it's 6 a.m. What are you doing?
Yeah, so I think this week especially is probably a good example. You have a jobs report on Friday, you have the Fed on Wednesday, you have really important data releases throughout the week. And so I think my job depends week to week. This week it is highly focused on what's happening with the data, what's happening with monetary policy in the Fed, being able to respond to those things for our clients and internal stakeholders in real time. Other weeks where there's less data, less Fed speak, I'm able to focus a little bit more on research, bigger picture ideas, think about inflation, the Fed's balance sheet, monetary policy. So really week by week, day by day, it's different, it's dynamic, it keeps me interested.
Yeah.
That's what I really like about it.
All right, well, hang with me there for a sec because I do want to mention a couple topics we do have off the top. Really, I personally crafted these for you, Matt. First, views on stagflation and potential for 8% rates. We have potential changes at the Federal Reserve if there is a change in the White House. And the third one, Nvidia CEO and potential AI job loss. But let me get back to your job, Matt. So when you meet with traders, you meet with stakeholders in Deutsche Bank, what are some of the biggest questions you're getting right now?
Yeah, I think the Fed monetary policy in the U.S. has been driving substantially markets, certainly rates markets, as you look at the front end of the curve, long end, but also risk and equity markets. So a lot of what I focus on is thinking about the nitty gritty of what's going into the Fed's monetary policy decisions. We have to forecast inflation. We have to think about where that's going. That's the most important thing for the Fed as they think about monetary policy. We have to think about the labor market, how that's going to evolve. Are we going to eventually get weakness there, as many have anticipated, or is the labor market just going to continue to chug along? So from my perspective, it is oftentimes Fed reaction function to different macroeconomic scenarios. We all have baselines. We all have kind of modal outcomes. Yeah. But what we've learned over the past 2 or 3 years is, those modal outcomes don't often get realized, and it's all about risk scenarios.
Did you start working at the Fed?
I did. So my career, I started at the Federal Reserve Bank of Philadelphia as a macro research analyst there.
What was that like?
It was great. I was right out of undergrad. I think at the time I thought I wanted to go get a PhD.
Or be the Fed chair at some point, right?
Maybe. But coming out of undergrad, you have pretty far more marginal goals at that point in time. Wanted to go and go and get a PhD, but didn't really know what it was about. Had to kind of beef up on math classes. Starting off at a regional Fed was really a fantastic way to do that.
So let's dive into this first topic because we have seen growth slow. We had that most recent GDP report. And then we have some top leaders like a Jamie Dimon at JP Morgan suggesting 8% interest rates over the long term. Are we in a stagflationary environment? Let's start there.
Yeah, I don't think so. So, last week, certainly we got a GDP report that showed 1.6% growth. It was disappointing relative to expectations, but let's both look into those data a little bit more deeply and take a step back. If you look at 2023, we had above 3% growth. You had disinflation that was substantial over the last year. Core PCE was what the Fed focuses on, was below 2% over the back half of last year. And really, if you look back to 2023, it was the best possible outcome that the Fed could have hoped for when they were embarking on this really aggressive rate
So basically,
hikes.
their job was too easy last year.
Last year was. I think that we're all finding out that it's not as easy as it looked last year, I think.
Yeah.
But that GDP report last week, I think probably overstated the weakness. Oftentimes, as an economist, I would look at what is the domestic private sector economy doing. So what's consumption doing, what's housing doing, and what are businesses doing in terms of investment and capex. That part of the economy grew 3% in Q1. It was very resilient, very robust. A lot of the weakness came out of these more volatile items, inventories, trade. They don't really tell you too much about the future. So I actually took kind of a solid reading about the U.S. economy away from that GDP report.
Let me push back on the stagflation point because we have growth that slowed, but we have inflation that is still, it's sticky. I talked to PepsiCo CEO, Ramon Laguarta, and he was outlining that he doesn't see the potential for him to lower prices in the back half of the year. Why? because his prices or input costs are still high. To me, that's stagflation. What are we missing?
Yeah, so I think that's the inflation part of it. And there I kind of do agree. We've seen far more stickiness in inflation over the past several months, at least, in the data than we were anticipating. We've gotten 3 straight CPI reports that were stronger than expected. I'm expecting over the next few months you do continue to see these reports that are uncomfortable for the Fed, that are uncomfortable for markets. So I do think the market's coming around to the view that inflation is going to be a little bit stickier. The other side of stagflation is that you have a high unemployment rate, you have weak growth. That's the area that I don't see.
That's a disaster.
Playing out. Exactly. That's an outcome as you go back to kind of the 1970s period. You had very elevated unemployment rates. You had happening at the same time as very elevated inflation rates. We're currently sitting here with an unemployment rate below 4% for the longest time that we've seen on record, with growth that looks pretty resilient.
To that person, the average person discovering the opening bid, podcast, YouTube, Spotify, you name it, or watching on Yahoo Finance, help them understand what is causing inflation to stay at these levels. I think we were led to believe, many folks were led to believe coming into this year, we would get a consistent path down. A lot of folks going to the supermarkets. I just spent $11 on some Primal Kitchen avocado mayonnaise. That was not normal, but I bought it anyway because it's really good. Like, why aren't these prices coming down?
Yeah, I think as we've gone back and you look over time, there's been different factors that have driven it. The early part of the inflation shock that we had, going back to 2021, it started off as this relatively narrowly focused thing on a few items that had very clear supply chain issues that were taking place. We all talked about used cars or commodities or food that was happening. Then it evolved to broaden out very substantially across services and goods. That part, I think maybe there were some supply chain issues as part of it, but we also had very robust fiscal stimulus. We had very easy monetary policy. We had excess savings for households that our metric was well above $2 trillion. So you've had about 10% of GDP in terms of excess savings. So there is a really important demand component to this that has made things sticky. Ultimately, that's why we think the Fed raised rates as aggressively as they did. And we thought for a while that was going to lead to weaker economic outcomes and that would ultimately bring inflation down. So far, that part hasn't happened. You haven't had these very weak economic outcomes. The key question, I think, for the macro environment now is, are those weaker outcomes necessary to bring inflation down from the Fed's perspective? Over the past year, they've, I think, signed on to this Goldilocks idea where they can bring inflation down without much pain. The past few months are starting to question that a little bit.
Well, that mayo really caused some pain in my wallet, man. That's really brutal. So 3 weeks ago, in one of our morning meetings here, I mentioned to the group, maybe the Fed hikes rates. My group laughed at me, and they continue to laugh at me. Now, since then, the past week and a half, we have seen some murmurs of one more potential rate hike. Is that crazy thinking? Do we get one more rate hike to just eviscerate all this inflation out there?
Yeah, it certainly doesn't seem as crazy as it did a few months
ago.
So
see, like I mentioned in episode 2, we do this in front of a little bit of a live audience, the Yahoo Finance newsroom. So you hear that Matthew Luzzetti suggests maybe a rate hike would be, not too crazy.
It's not too crazy. I think that you can think about outcomes over the next year.
Thank you. I'm just going to go like this.
Absolutely.
Thank you.
And part of what I have to do is maybe think about what those outcomes are that could get you there. We think about risk scenarios. We have to write about risk scenarios, scenario analysis.
Mind you, I don't want to be there. I don't need higher rates. I already don't own a home, but we'll leave that off. That's a discussion for a second day. Go ahead.
Yeah, I don't think anybody wants to be in a world or environment where the Fed is rethinking hiking rates at this point in time. But the reality is, look, inflation does look like it's stickier. The Fed, I believe, is kind of firmly committed to getting inflation down to target. And the question will be, what do they need to get there? If you think about scenarios that would get you to another Fed rate hike, I think it's that core PCE inflation has to accelerate above 3%. It has to look like not only that progress is stalling out, because the Fed has told us that stalling out says that they just keep rates where they are for longer, but that it's accelerating in kind of an adverse way. Now, does that happen? That's not our base case. We do think that the Fed could probably cut rates once this year, at the end of the year in December, as they get disinflation progress. But the possibility that inflation could accelerate from here is definitely more real than it looked 3 or 4 months ago.
So you're still looking for one rate cut end of this year?
That's our baseline.
What is the era of ultra low interest rates? Is it over? Of course, the Fed has raised rates consistently since 2022. Of course, so we're in a higher rate environment by extension. But look back a decade ago, rates were low for various reasons. Is that just done, never to come back again?
Yeah, I think that there is something that does look kind of persistently or structurally different relative to that period between the GFC and the pandemic. if you think about what happened during that post-GFC world, you had significant private sector deleveraging in the US and elsewhere, something that historically just very rarely happens. You had fiscal policy in the US that was actually contractionary for a period of time. Fiscal policy looks very, very different today, running very large budget deficits. You had euro area crises, you had negative interest rate policies across the globe. All that was feeding through into the US yield curve, leading to historically low interest rates. I do think that period is behind us. All those things that I just mentioned in terms of being key factors, most of them have gone away. Most of them have reversed as we look ahead. And just evidence of that is if you asked most economists, if the Fed were going to raise rates by over 500 basis points, what would happen to the economy? We all kind of thought that you'd see this greater softening and weakening that would take place, perhaps a mild recession. That didn't play out. It does tell you that the economy can take these higher rates at this point in time.
You mentioned deficits. I think you and I are around the same age. Is it our generation that's going to bear the brunt of all of the decades of just freewheeling government spending? I mean, the national debt is just a major problem, and maybe it is starting to become reflected in Treasury yields.
Yeah, you had a period last year. It was a short period, but it was basically July to November, where I received almost entirely questions about who was going to buy U.S. Treasury debt. And it wasn't just from U.S.-based investors, it was global investors. It was the key question for markets, and you saw that it roiled risk assets, it roiled equity markets as the 10-year Treasury yield hit 5%. And then what you had is early November, the Treasury came out, said we're going to issue a little bit less at the long end of the curve. You had the Fed sound more dovish, and that gave global investors a lot of confidence to come in and take what looked like a juicy 5% Treasury yield. That has, I think, moderated things. But as you look longer term, it's just undeniable. I mean, debt ratios are rising. If you look at deficits relative to GDP, we're running at 5 to 7% as far as the eye can see. That probably understates things because, for example, the Trump tax cuts are assumed to expire under the current legislation. So yeah, I think this will be a persistent story for markets. It's always hard to predict, when it becomes a story, when markets will focus on it, when you have risk premium built in, but it hasn't been resolved.
If you're watching on our streaming platforms, we're heading for a quick break. Everyone else, stay with us. We're still rocking our 24 minutes today, as usual. All right, welcome back to Opening Bid. Now, you mentioned the Trump tax cuts, and I think that segues nicely into this next topic. Interesting Wall Street Journal story recently about potential changes to the Federal Reserve if President Trump does win a second term. How important is Federal Reserve independence to markets in the economy?
I think it's absolutely critical. As you think about central banks, one of the main things that kind of academic literature and practice that we've learned over time is that central bank independence is just crucial for achieving price stability, getting inflation in check, creating a backdrop for markets where they can trust that inflation will come down over time, creating a backdrop for consumers and businesses that they can trust that inflation will come down over time. And Chair Powell says often that getting to maximum employment, keeping low unemployment rates requires that they achieve price stability. So I think as we look ahead and you kind of contemplate how things might evolve, the market I do think will be a big disciplinary action on what happens in terms of thinking about the Fed chair, changes to monetary policy. Because if you have an environment in which people are cutting rates in order to juice the economy, but are not thinking about inflation, then as we were just kind of talking about, that inflation risk premium gets built into markets. The long end of the curve does rise. That impacts risk assets. It impacts pensions and things that everybody holds. So you can't just keep the front end of the curve down. Markets will respond and react and build in a risk premium at the long end.
Is it crazy to just even think of a president, whoever it might be, to have a say on interest rate policy?
Look, I think actually in some of those articles there was this history that was provided in which at times there was very strong views that are happening from the White House or the presidency about what should happen with interest rate policy. I don't know that it's crazy to think that presidents should have a view. There's an entirely separate question of whether or not that view is imposed or some way conflicts.
A view, but not a say.
Correct.
Not like, so the Fed comes up with their rates, but they have to get an approval from a president. That's just...
Correct. I believe very strongly that Fed's independence in terms of setting monetary policy is critical. I think we've seen that play out over the past 3 years. The Fed raised rates very aggressively over the past 2 years. They did 4 straight 75 basis point rate increases. They did what they thought was necessary in order to bring inflation down. And they learned from history, which was if you don't tackle these issues early on by being aggressive, it can actually be far more painful as you look ahead. So that independence, I think, the importance of it, the criticality of it really played out over the past several years.
What if the Fed had to have some form of oversight by the Treasury Department? Would that upset markets?
Look, I think markets are comfortable with the status quo. They understand what an independent Fed does, how an independent Fed operates, how they internalize data, how they make monetary policy decisions. I think any changes that impose some type of political nature or calculus on top of that will be problematic.
How important is it that Jerome Powell stays atop the Federal Reserve? His term is up in 2026?
It is. So in 2026, I think it could be likely that he might leave at that point in time. I think he views it as being critical to his legacy that he gets inflation down. He's talked about that a lot, and so far at least, they're certainly not all the way there. We talked about sticky inflation. There's still a lot of work left to be done.
Please bring my mayo prices down, Jerome Powell. He has to do. Please just do it.
Most important is avocado mayo.
Yes, thank you so much. Thank you so much.
We have to bring those prices
yes.
down. It's a platform everybody can get behind. Yes. But I think that's his legacy. His legacy is ensuring that when he leaves, inflation is pretty close to target, and if he achieves a soft landing as part of that, which now looks most likely, a year or two looked very unlikely, that's a pretty good legacy. So, I think as you look out to 2026, it seems reasonably likely that we do have another Fed chair at that point.
Are you getting questions already on who his successor could be?
We do. You hear and you look at media reports that do report those things. I think it's very hard to know. I mean, it's highly conditional on who wins the election. The election looks very close at this point in time. And then from there, it's hard to know who might be there. We do get questions. At this point, I don't think the market is really pricing anything. It's out to 2026, so it's not something that's front and center for the market at this point in time. But certainly that's an important consideration for the market. And as we get closer to the election and beyond it, markets will focus on it.
I want to leave a good chunk of time for AI and jobs. Really, Nvidia CEO Jensen Huang hops on 60 Minutes, and he proceeds to say that AI won't be a job ruiner. Now, I get it. I mean, he's the CEO of an AI-powered company selling lots of chips, one of the most valuable companies in the world. I understand his position. How do you see it from an economic standpoint?
Yeah, I think from an economic standpoint, there is a long history here. I mean, this is not going to be the first labor-altering technology that we have and see. You've had that many times over historically. I think as you look at that history, it's not often that you see the unemployment rate rise in any type of structural way. And so I think that makes sense that we don't think of technology generally as a big job destroyer. That doesn't mean that it doesn't have effects for certain types of jobs, certain occupations, certain industries. There's a lot of great work being done on what types of jobs have things that can be complemented by AI, what types of jobs have things that can be substitutable to AI. And that really does help inform, I think, how those effects can take place. But I think ultimately the history is pretty strong. Technology does not tend to be a big job destroyer.
Is it a creator?
It can easily be a job creator. Both by introducing new types of jobs. Things like prompt engineer, something nobody knew was the thing a year ago, is now a big job driver. By boosting your productivity, you can do more. Demand could be higher. There can be some job gains that take place out of that. I don't want to downplay. There's a lot of heterogeneity. It impacts different occupations, industries very differently, and you do have big macroeconomic shocks that can impact certain sectors and certain occupations historically. You don't want to downplay those things. But from an aggregate perspective, they tend to be positive.
I thought my job was safe doing this until I saw Reid Hoffman, LinkedIn's founder, posted something, an AI version of himself a couple days ago, went viral. It sounded like Reid, it looked like Reid. I'm like, wow, maybe my job isn't safe. But do you see AI being a real productivity unlock? Is there going to be a new productivity miracle?
Yeah. First, I don't think AI can replace you.
Oh, you're just saying that because you're on opening bid. I mean, come on, I appreciate that, man.
No worries. Look, I think from a productivity perspective, we are very constructive on what AI can do there. But taking a step back, I don't think you need to have a strong view on AI to think that productivity growth over the next several years could be very strong. And the reason is, historically, when you have tight labor markets, productivity growth tends to follow it. And the logic is, if employment is costly and employment is difficult to find, as it has been over much of the past several years, it incentivizes firms to do productivity-enhancing things, to do CapEx, capital deepening, optimize your inputs, and you tend to see historically that productivity growth follows that. Over the past 3 quarters, we've had very robust productivity gains. I don't think that's a fluke. I think that's something that continues.
Has AI changed your job and what your teams do?
Not functionally yet. I think we're still in the process of figuring out kind of how safely we can implement it, use it in real time for the job that I do. Certainly, I think that there is going to be scope for over time for it to be quite complementary to things that we do. Hopefully, complementary.
Yeah, well, you can't be replaced. You're not going to be replaced.
And not substitutable, but.
I try to leave the last couple minutes for on the podcast to help inspire new investors out there or people just getting into the investing game. And it's not often they get direct access to folks like you, Matt. What, in terms of best advice to someone sitting at home, they're new to the market, how could they study the economy like you that maybe don't have the tools and access and things that you have?
Yeah. So I come at it from probably a different perspective than a lot of your guests. I have a background at the Fed. I'm an economist. I went and kind of did a PhD in economics. So the way that I approach things is going to be quite different, and it's going to be very macro focused. And from that perspective, I do think what is great today that we probably haven't had for a long time is how much research we get from the Fed, how much access we get from them, how many alternative.
Is that a good thing?
I think that
all these Powell speeches and all this Fed speak.
I think the research that we get is fantastic. Certainly you do have a lot of Fed speak that can tend to move markets. But I think the research that you get, kind of the alternative data series that we get, is hugely helpful. I mean, just one example now is we have all these private sector estimates of rental price inflation, something that we didn't have for kind of decades before. I think it's been critical in setting monetary policy. Because if you look at where shelter inflation is today, rent, owner's equivalent rent, it's still very, very elevated. And if the Fed didn't have some confidence that that was going to come down, they would sound far more hawkish, I think, today. I think they may have raised rates even further. And so finding the data that's out there that can kind of provide you with unique insights is important, and we have a lot greater access to it today.
The most important economic indicator that someone at home should be studying regularly?
So I'll do maybe one that's a little bit different than
Good.
I think today it's all about inflation, but I don't want to talk about inflation as much. I think if you look at the quits rate in the US economy, so this is the percentage of people that are actually actively quitting their jobs, it's just remarkable how that has been the best indicator for labor market slack. It's the best leading indicator for wage growth. It's kind of this great summary statistic for how you should think about the labor market. Janet Yellen used to talk about it when she was Fed chair. We'll get an update of it this week with the JOLTS data. And I really do think it's important for thinking about the economy right now, because right now it's telling you that wage growth should normalize over the next several quarters. If that happens, I think the Fed feels a lot more comfortable with potentially easing off on rates at some point in time. But if it reverses, when inflation is already high, showing a tightening labor market, accelerating wage growth, that'd be really problematic.
The next time I see you, will my mayo be $8?
I hope not for you.
You want me to keep paying $11?
No, I don't. No. For your case, I hope it is.
All right.
Oh, $8 is good.
$8 is good. Okay,
Yeah.
all right. We'll leave it there. Deutsche Bank Chief U.S. Economist Matthew Luzzetti, thanks for always making time for Yahoo Finance, and
Absolutely.
welcome to the Opening Bid fam. We appreciate it.
Thanks for having me.